In today's report, sharp movements in the precious metals market unfolded exactly as previewed over the weekend, but the broader story has since taken a more complex turn. Physical-backed crypto markets continued trading while Western exchanges were closed, showing silver near 100, hyperliquid at 96, and PXG gold at 5,400. At the same time, Western spot prices had closed Friday at 93 for silver and 5,278 for gold. Those weekend premiums suggested that traditional markets could open higher, and that is precisely what occurred. Silver opened with a gap from 93 to nearly 97, and gold moved above 5,400. However, the early surge did not hold. Silver is now trading at 90, while gold stands at 5,346. The reversal has shifted attention away from the initial gap higher and toward the forces driving the current price action. As U.S. markets prepared to open, China experienced a significant wave of physical gold buying. The country's largest e-commerce platform adjusted gold prices to the equivalent of $5,574 per ounce. Shortly after, major physical gold retailers across China reported that investment-grade gold bars were no longer available. Only craft or decorative gold products remained for sale, priced at the equivalent of $6,329 per ounce. At the time of recording, Western spot gold stood at $5,346, indicating roughly a $1,000 premium in Chinese retail stores due to the shortage of investment bars. The surge in demand also affected digital platforms. Jingdong Finance, which offers gold accumulation products in partnership with Jashang Bank through China's largest e-commerce platform, experienced severe congestion when markets opened. Users reported being unable to log in or complete purchases. With 336 trillion yuan in savings across the country, a significant portion appeared to move toward gold simultaneously, overwhelming the system. Every major bank reported a rush into gold, and Chinese gold mining stocks reached their daily limit up. This rapid shift into physical metal unfolded in the world's largest gold-consuming nation. Notably, while Chinese mining stocks surged, Western mining shares have not yet followed the same trajectory. At the same time, geopolitical developments escalated across the Middle East. Iran has carried out strikes affecting 15 different countries or military positions. Those include Israel, the United States, the United Arab Emirates, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, and Cyprus, along with French, Italian, and British military locations. Saudi Arabia's Ras Tanura facility, the largest oil refinery in the kingdom, which processes approximately 550,000 barrels of crude per day, has halted operations following an Iranian drone strike. Iranian drones also struck Qatar's Ras Laffan energy complex, a key component of global liquefied natural gas infrastructure. Qatar Energy has stopped LNG production. Qatar accounts for roughly 18 to 20% of global liquefied natural gas supply. Following these events, European natural gas prices surged 47% in a single day, marking the largest one-day increase since Russia's invasion of Ukraine in 2022. In Kuwait, air defenses shot down 3 U.S. F-15E fighter jets. The United States has canceled 41% of all scheduled flights in the Middle East. President Trump stated publicly, "We haven't even started. The big one is coming soon." With Saudi Arabia's largest refinery offline, Qatar's LNG production halted, and the Strait of Hormuz described as functionally frozen, approximately 30% of global oil supply is effectively offline or disrupted. Despite this, oil prices, after initially rising 8 to 9%, declined from 73 to 70. When trading opened in New York, gold and silver moved in sharply different directions. Gold remained higher on the day, while silver declined significantly. Before full trading was underway, silver was pushed below the $90 level. From its recent highs, the metal fell nearly 8% within a short period. One explanation centers on the broader macroeconomic backdrop. A sudden supply shock can create growth concerns. Silver derives approximately 50 to 60% of its demand from industrial applications, including solar panels, electric vehicles, electronics, artificial intelligence infrastructure, and defense manufacturing. Large-scale energy disruptions directly affect projections for those sectors. Gold's demand is primarily monetary, and in periods defined by growth uncertainty, gold has historically led while silver has lagged. From a technical standpoint, silver found support at 88 during the New York Open, aligning with the 150 exponential moving average on the hourly chart. The price has since rebounded to 90. If silver fails to hold and reclaim the 150 EMA on the hourly time frame, levels near 84.9 and below remain possible. Meanwhile, Shanghai spot silver is trading at 102, compared to Western spot at 90, and Shanghai futures stand at 105. Even after the decline in Western markets, the approximate $12 premium between East and West remains intact. Attention has also turned to positioning within silver exchange-traded products. The largest holder of SLV is identified as Jane Street, with a reported position valued at $1.3 billion. The focus remains on the scale of influence associated with such holdings. Rapid advances can attract retail participation, while sharp pullbacks can force exits, particularly in highly liquid instruments. Several structural elements remain unchanged. China experienced a surge in physical gold demand significant enough to strain online platforms, and retail stores reported shortages of investment-grade gold bars. The country's 336 trillion yuan in savings represents substantial capital seeking stores of value. Shanghai silver maintains a notable premium over Western spot pricing, and Chinese retail gold has traded roughly $1,000 above Western spot due to supply constraints. At the same time, major energy infrastructure in the Middle East remains offline. European natural gas prices have recorded a historic single-day increase, and oil markets are reflecting a divergence between supply disruptions and price action. These developments together define the current market environment.